Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Mathew. Now, you've seen some phenomenal success stories in the primary markets over the past few months, and it's been a tremendous opportunity for companies to earn from the markets. It's also been a phenomenal opportunity for you, the investor, but the caveat is only if you were able to participate in that IPO process. And the reason why this is a question is because there is a lot of demand for the IPOs that have been hitting the markets of late. Now, there is another way for you to participate in this, and hopefully this next conversation will give you a perspective into that. I'm talking about the mutual fund scheme that invests in IPOs and recently listed companies. It is from the stable of Edelweiss Mutual Fund, and we're in conversation with the fund manager of that fund so that he can tell you what his thesis is when he is investing in these IPOs. I'm joined by Bharat Lahoti, Fund Manager, Hybrid and Solutions at Edelweiss MF. Thank you so much, Bharat, for joining us in the studio.
Thank you, Alex.
So let's talk about this opportunity first of all. You've seen a lot of frenetic activity, if I can call it that, in the primary markets, and this is par for the course. We often see periods of significant action and then lulls. But what have you made of this most recent season?
Alex, so if you look at the IPO, as you rightly said, there would be times where there would be many IPOs in the market. There would be times there would be a lull kind of scenario. And it all depends on how the underlying capital market behaves. If the capital markets is active, we will see a lot of IPOs which are coming in. And you would see actually also in terms of valuation, the way the primary deals have been valued is also a function of capital markets behaved. In the early part of the cycle, you would see actually a lot of discount to existing peers, which will happen for many of the IPOs that get listed. And then eventually the discount gets narrowed down to be on par with the peers, and then sometimes also premium to the peers. So the investors have to be very cautious about IPO markets in general. When are you getting into IPO markets? How they are getting into IPO markets? Because selection is very important in IPO markets. If you look at data suggests that 30% of companies have not actually reached the price of listing price for many of the companies which have been listed over the last 8 years.
Wow, okay. So that's a significant underperformance, so to speak. 30% of companies, you're saying, in the last 8 years that have hit the market have not managed to hit their listing price. And that is over the life cycle. Wow, okay. So, which is why a pray and spray kind of an approach does not work, but that effectively is what retail investor is currently engaged in, most of them, because the probability of getting allocation is very low, right?
Yes, retail investor faces three issues at the IPO investing. One is selection. How do I select IPOs? All IPOs, as I said, don't make money. If you look at more detail, actually 55% of IPOs actually underperform the NSE 500 index.
Okay.
So that
over what period?
Over the period which have been listed out, however it has been listed out. So if you look at that data, that is one. Second important thing is that subscription numbers are pretty high for many IPOs when you get into. So access becomes extremely difficult for retail investor. If you look at HNI subscription, things have been like 20% times, 50 times, 100 times, 150 times. There's a lot of numbers which are there. So access becomes extremely difficult. Third is about how do you hold many of these companies for post-listing. When you have done right selection, you can actually build on to some of these companies actually and build position onto it. So post-listing gains, which most of the people miss out, is the biggest part of the wealth creation, which I think is there in the IPO process.
If we're talking about listing gains specifically, I think, and we were trying to pull some data as well, maybe you can share some data that will be beneficial to us. In that, at least in the recent past, in that first week of gains itself is where you have that sweet spot, and you kind of book out and you make the most money that you potentially can make. Is that the correct way of looking at it? Or do you have data to suggest that holding for long term has been beneficial?
So if you look at it, what you make money in terms of wealth would be very small part of it. What you get in allocation in an IPO process is very small. So if you look at from a retail perspective, retail investor gets in a lucky draw system only value worth 15,000 rupees.
Yes.
And for HNI it's 2 lakh rupees kind of stuff. So even if the company gets doubled during the IPO listing process, you actually earn only 15,000 for retail investor. Actually, you don't make too much of wealth. The wealth is created only over a period of time when you actually remain invested in some of the companies for a long period of time and actually get the benefit of the earnings compounding which is going to happen for those companies.
What are the restrictions for an institution though? And I'm asking because you participate as a fund in the anchor process as well, right? As an anchor investor, and recent IPOs you have participated in the anchor investor. What is the extent to which you can subscribe?
So there is no limit to in terms of it. If you look at from an institutional perspective, at max we can actually participate 10% of the company's market cap.
Right. That is the SEBI restriction.
That is the SEBI restriction. What we can do about it. That is the maximum we can do about. And beyond that, it's all about proportionate allotment. So depending upon the QIB subscription, we get allotment. Yes, you are right. We can participate in anchor deals, which is confirmed allotments. So those are also area where the mutual fund has an edge as compared to the retail and HNI customers.
I want to understand the recent season, or if we can call it that, this season of IPOs. You've said that there are peaks and troughs in that as well when it comes to valuation and what the investor can get. Where are we in that cycle?
So if you look at it, 2021 was one of the peak of the IPOs. And as we moved from 21 to 22, markets also started correcting, mid-cap stock, small-cap started correcting, and so is the valuation of many of the IPOs. If you look at it, the IPOs which have come in the year 2023 has been reasonably priced as compared to what was there in 2021. So we are not at the peak as of now. That's what we are understand. If you look at even the last month's IPO, many of the companies which have come in the market are actually been asking for a price which is 20-30% discount to the listed peers. So this is not right now the peak of it, but yes, the peak can happen within 1 month, 3 months of time that can happen.
Interesting. I also want your perspective on your thesis, right? So that my viewer can understand what your objective as a fund manager is. We're talking about the Edelweiss MF IPO recently listed IPOs, right? That's the name of the fund. How does it work?
So this is a thematic fund where 80% of money gets deployed in last 100 IPOs kind of stuff. It's a bottom-up research process what we do, because IPOs do come out through various sectors, various market capitalization. The way of managing this fund is, or the style of managing this fund is more growth-oriented, more quality-oriented. We don't look value in the IPOs in general kind of stuff, because we think it's a value trap which happens in many of the IPOs. So generally looking for a value in IPO is a थोड़ा risky strategy.
Why do you say that?
If you look at it in Indian context, what are you playing for it? You are playing for India growth story for next 5, 10, 15 years. That is the case where we do think. These are the companies which are the next growth driver for India. As India moves from a 3 trillion economy to 5, 7 trillion economy, these will be the drivers for the economy. So the idea is to play that growth story rather than play a value story to that extent. Second important thing is that obviously all IPO companies don't make money. You have to be very quality conscious in this frame of work. If you look at the 100 IPOs universe, last 100 IPOs, you will see at least 10-15 of IPOs don't qualify for the quality metrics in general. Those are typically avoid companies for us, and we don't actually participate at all in these companies to that extent. So you have to be quality and growth focused in this universe in general. That's what our investment philosophy has been there for this fund.
Understood. You know, I want to understand about your stock selection process, which you just mentioned, and also how there are exits and new entrants. But I will ask you that after this very quick break. Viewers, do stay tuned. We'll be back before you know it. Welcome back. You're watching the Mutual Fund Show, and we're speaking about the Edelweiss recently listed IPO fund. We're speaking to the manager of that fund, Bharat Lahoti. Bharat, now we kind of delved a little bit into the stock selection part of it, and you said that there is a matrix and there are 100 companies that you have on an ongoing basis in your fund. Now, I'm trying to understand how you determine how many of these go out and how many go in, and what the vintage is. So first, these 100 companies at this juncture, what is the average vintage of the stocks that you're holding?
So if you look at it, this is not a fund where we invest in all 100 IPOs which are there.
Sure.
It's a fund where we select few of them in our fund to that extent. Typically in our fund, we have 40 to 50 companies. The way we approach this selection process is very threefold kind of stuff. We divided companies into 3 different buckets. One bucket is secular growth ideas, where we think the sector itself is growing very fast. The company actually is gaining market share because of differentiated products or delivering differentiated goods and services, which is different from the rest of the market. Consequently, they are actually gaining market share. The second idea is we understand, yes, IPOs do come when the sector is hot, and you would find many companies within that sector coming for the market. We typically tend to identify niche companies within the sector. To just give you example, we try to find within housing finance company, can I get an affordable housing finance company which is operating in a tier 3, tier 6 segments kind of stuff. So if that is the case, that's an interesting idea within the housing finance segment to that extent. So those kind of niche segments we try to find out. Third important thing is the avoid ideas, which is very important in IPO space. Typically, we tend to avoid companies where we have a lot of corporate governance issue. The history of the promoter is not so great. There is a high leverage on the balance sheet. If the visibility of earnings is in out years or actually not at all, we typically tend to avoid companies. And I said that typically 15 to 20 companies within the universe is actually avoid companies.
Sure. So, but then how long do you hold? What is the average holding period of the stock in your portfolio?
So typically, if you look at it, the way we think about it, when we invest in a company, we have a view of 2 to 3 years.
Sure.
How the company is going to behave in next 2 to 3 years. That is the plan which company also comes up when they come for IPO. And that is our holding period. If you look at my average holding period of the companies is more than 2.5 years kind of stuff. It also depends upon how many IPO companies do come in the market. If there are many IPOs which are going to come in, obviously the holding period will reduce. If there are fewer IPOs, the holding period will increase.
So, and then the other thing is, how do you manage your cash? So I would think that in periods where you anticipate that there will be opportunities, you will choose to hold a little more cash than you normally do. On an average, how much cash do you keep?
On an average, we keep a couple of percentage cash kind of stuff. In an IPO process, if you look at it through anchor deals and through new IPOs, we typically try to actually build position gradually over a period of time. It doesn't happen that on the first day we try to build the entire position. For us, the investing starts from the anchor deal, main book, post-listing, 1 quarter down the line, maybe 1 year down the line. Whenever we think the opportunity is right, we tend to invest. We have skipped sometimes anchor process and the IPO process and actually participate after 1 month, 1 year down the line for many of these IPO companies. For us, there is no need to be rushing into the IPO at the IPO time itself.
And how do you decide the quantum that you hold in each stock? You said that you can go up to 10%, but also in your book or in your portfolio of stocks, I've seen that the maximum holding is around 4% or thereabouts, and the top 10 account for about over 30%. So how do you decide what the quantum of the AUM will be in each of these?
So as I said, we divide stocks into 3 different buckets. The secular growth idea gets the maximum weightages. If you look at my portfolio, 80% of portfolio is in secular growth ideas and 20% of portfolio is in the cyclical ideas. And typically when we try to size any stock to that extent, we have limits in terms of it. For a secular growth ideas, we don't invest more than 5% at the time of investment. For cyclical ideas, we invest not more than 3% at the time of investment. There are limits, internal limits in terms of how you manage the risk for any of the stocks.
Have you ever not anticipated, but experienced, and this is something that happens in a book or a portfolio that is kind of tilted towards small and mid cap, but particularly small cap, right? So you have a substantial portion of your portfolio that is small cap. Liquidity issues ever?
Yes, it's a very important factor in the IPO markets. You might see that stock is going up, but you have to also think about it. How do I going to liquidate or actually that? So we have a very close eye in terms of how we are building position on many of these companies. Though the companies could look very good in percentage format, this company is delivering great set of returns, but we keep a close eye on liquidity. If you look at my liquidity profile of the fund, actually in 5 days I can liquidate 80% of my portfolio. So that's a highly liquid portfolio what we are running in the IPO universe. Because IPO stock also has a low free float. You have to understand
yes,
on the fact,
exactly.
and consequently you have to be very about fact that it could have a risk to what we run to that extent.
But you're not married to any of those ideas, and at any point of time if you see red flags you can get out of them, and that really is the nuance in that strategy, right?
Yes, so if you look at it, there are times where the IPO companies actually change the plan midway.
Sure.
So we have actually exited some of these stocks, saying that this company actually planned for something else when they came for IPO, and they have changed the course in between. So we have exited. There are times where actually the environment itself gets changed. Like during IL&FS crisis, actually the environment for NBFC had changed dramatically. So we have to recalibrate in terms of how we want to actually look at the financial pieces. So we typically, this is an active fund. You can't run a passive fund in this kind of environment to that extent.
So, and I'd like to offer this as an opportunity to all the fund managers that come onto this program, a message to the investors in terms of what they think the investor should have in their mind when they approach investing into their fund. So I'm going to throw that to you. What, according to you, should be the objective or the mindset of an investor when they decide to park their money with you?
So great. If you look at it, IPOs do come in phases. The way to participate IPO is through an SIP route. Investors who have come through an SIP route in this fund have actually far better experience as compared to people who have come through lump sum route. That is one important aspect. Secondly, the time horizon for this fund is all about 3 to 5 years. If you have a lesser time horizon, it's better to avoid this kind of fund to that extent. Third important factor about this fund is also about investing from a 3 to 5 year perspective, where we are looking at India growth story to that extent. So you will find new sectors coming into the market, and this fund will have that kind of companies to that extent. So that is where we are looking for it, the investor to think about this fund.
Fantastic. All right. Thank you so much, Bharat, for taking the time and for speaking to NDTV Profit. It was our pleasure having you in the studio.
Thank you, Alex.
And viewers, do stay tuned, because we're going to tell you how this fund could potentially fit into your portfolio and what you need to bear in mind. That's coming up after this break.